Good afternoon, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. And ooh boy, what a day it was, guys, ending very red on the day across multiple sectors in the wake of a hotter than expected CPI report. So was it an absolute disaster, or are the markets potentially overreacting to the CPI report we had this morning? We're going to take a look into the details of that inflation report and break it down in terms of the rate cut probabilities for March, May, and June. And we're also going to take a look at what yields are doing, because yields were skyrocketing on the day after the back of that news on the morning. We also have two earnings that we're going to go over today, since I do want to cover a lot more technical analysis with this drop today. We're only going to be going through two earnings in the names of Coca Cola and AirBNB. AirBNB reporting earnings this afternoon after the close. And we're also going to do a major rundown here of our technical analysis on the indexes, our major tech names, and the portfolio update will be reserved for later on in the week as I just continue to churn over more positions. So we'll do an update on that later in the week. Going to keep most of today's focus on the technical analysis, because when we have big surprising drops like this, we need to know where we stand. So let's get right into today's video, guys. SPY down 1.38%, almost down 2% at one point on the day. QQQ ending the day 1.56% to the downside, was over 2%, almost 2.25% drop at the peak of the drop on the day. And very red across the board was really a surprise reading on the CPI, which really crushed most of your major indexes here. And you can see that best on the heat map. Everything, guys, almost everything, except for pretty much Visa, MasterCard, and a few healthcare names, very, very red across the board. And we were kind of expecting this, guys, a little bit of a pullback, and CPI could have been a catalyst for it, right? CPI, I was saying it could either go either one or two ways, but most likely it would have led to a drop in both situations. Number one, the report would have been extremely good. We were already in overbought territory. That could have led to a severe gap up open, 1.5%, maybe 2% on your indexes. And thereafter, we most likely would have went into consolidation after having been overbought for all this time. But now situation number two has unfolded, where the report actually provided a beautiful opportunity for some market consolidation, and nobody would have looked the other way just based off the back of that news. So that is where your major crush has come into the market, mostly affecting the names that have run the most here over the past 3-4 weeks. On a sector relative performance, you can see that the picture is fairly bleak as well. Everything in the red by almost multiple digit percentage points here, right? So 2% on technology, real estate, basic materials, and really negative 1% across the board here. So very red day across the markets as a whole. Your loss leader, IWM Russell, with a 4% downside day. It's been a while since the IWM Russell has put in a 4% day to the downside. So that has been a record day, unfortunately, for the Russell to the downside, as they are most exposed to yields. So before we get into the actual technicals, let's take a look on where we stand in terms of that CPI report, right? So let's take a look here. Exactly what happened. Prices rose more than expected in January as inflation won't go away. Heck of a headline, right? Shelter prices accounted for much of the rise, climbing 0.6% on the month, contributing more than 2/3 of the headline increase. On a 12-month basis, shelter rose 6%. So guys, we were expecting a 2.9% annualized read. It came out at 3.1, but 3.1 is not that bad, guys. It's still lower than our December 3.4%. And I said I would be nervous if today's read came in at 3.3, 3.4. But as you can see, 3.1 is still significantly off your December read. It's exactly in line with November, and it's just short of the June read, which was the all-time low in terms of the past couple of years in terms of inflation. Core is also trending nicely down, still under 4%. So where were the issues? What did the market have issues with in today's report? Well, it was just above expectations. The CPI, right, increased 0.3% for the month. The BLS reported on a 12-month basis, that came out 3.1%, down from 3.4% in December. So that's what we were looking at on the chart down below here. Now, the survey had been looking for a monthly increase of 0.2% and an annual gain of 2.9. So we missed on a month over month by 0.1, and we also missed on a 12-month rolling basis. The expectation was 2.9, and we got 3.1. So really a bit hotter than expected, but still trending downwards. And what I wanted to show you guys is, obviously, when we come out with a hotter inflation read, you may just think, well, the Fed is not going to cut interest rates. They'll have to maintain them higher for longer. Well, here's the discrepancy, guys, and this is a big one. This is why I do deem that the market isn't really viewing this as such of a negative event. Sure, temporarily in terms of the short-term price impact, yes, but in terms of our narrative, is the Fed going to continue to cut rates before the midpoint of the year? Well, the probabilities would indicate that yes. So here's your probabilities for a March Fed rate decrease, right? So we still stand at our current interest rates for about 92% probability. So there should be no cut in March. And that really has changed over the past one day, as if anything, this CPI report really took the March meeting off the table completely. Yesterday, it was standing at 16%, so not a high chance of a rate cut. Now only 8.5, so it's pretty much off the table. But take a look at the rate odds for May after this report. Yesterday was only sitting at around a coin toss, 52.2%, and even a week ago, guys, was sitting about a coin toss as well after Federal Reserve Chair Jerome Powell's comments at the Fed meeting about a week and a half ago at this point, right? Where he was saying that they just didn't have enough data yet to consider the March meeting to be appropriate for rate decreases yet. So he was a bit hawkish in saying that. And meanwhile, over the past week and over the past day, our rate cut odds for a decrease were only sitting at about a coin toss, 52%. But after this report, they're now actually up to 62%. So it just goes to show that the market is actually reacting to the fact that inflation is still trending down. Yes, the read came in hotter than expected, but it's still trending down, and it's still down from December. And that's why traders are now pricing in a higher probability for a rate cut in May. And June just continues to reiterate this point as well. Take a look at your 0.25% decrease odds for the month of June, if ever they don't happen in May. Well, yesterday and the week prior, right? The week prior, 35.5%, and one day ago, 41.9%. But now traders are pricing in over 55.6% that will have at least one rate cut in by the month of June. So probabilities going up for May and June for the rate cuts. That just goes to show that traders are reacting to the direction of overall inflation coming down. Now, is it stickier than expected around certain aspects? Yes, and we're going to look into that right away. So excluding volatile food and energy prices, the so-called core CPI accelerated 0.4% in January and was up 3.9% from a year ago, unchanged from December. So that's your core line right here, still sitting around 3.9%. Shelter prices, which comprise about 1/3 of the CPI weighting, accounted for much of the rise. The index for that category climbed 0.6% on the month, contributing to more than 2/3 of the headline increase. So shelter alone, 66% of your inflation read for the day in terms of the reason for the increase. Food prices moved higher as well, up 0.4% on the month. Energy helped offset some of the increase, down 0.9% due to largely to a 3.3 slide in gasoline prices. Now, here is what Wall Street is thinking about the whole gist of things. Inflation is generally moving in the right direction, but it's important to remember that a lower inflation rate does not mean that prices of most things are falling. Rather, it simply means that prices are rising more slowly. Consumers are still feeling the pinch of high prices for the things they buy most often. So this is a little bit of a discrepancy, a little bit of a fallacy that a lot of people mention to me when I talk to them that inflation is coming down. So in 2022, we experienced price increases of this, right? This was your steep increases. So let's say something started off at $1 down here. It's now down to something like $1.50, right? $1.50, excuse me for my artwork. And now prices are still increasing, but they're increasing really, really slowly at this point. So we're done with inflation that is really bad for an economy. We're returning to a normal price trajectory. But the important part, guys, is that prices of most of the items that you purchase in grocery stores or otherwise, they will not fall back down to what they were prior to our first inflationary cycle of 2021 and 2022. It's just not going to happen, unfortunately. Prices will continue to rise, however, at a slower pace. And that's the Fed's point. They want to get this future pace to 2% and avoid going back to something like this. Going back to something like this is largely out of the question. Now we are returning to a more normalized, stable rate of growth on inflation. The much anticipated CPI report is a disappointment for those who expected inflation to edge lower, allowing the Fed to begin easing rates sooner than later. So that's why you had a negative market reaction on the day. It's basically saying that March rate cuts are pretty much off the table for now. But as I've shown you in the probabilities, guys, probabilities have actually increased on your rate odd cuts for the month of May and June, just because CPI is still trending in the right direction. And hopefully with another few data sets before the month of May, so basically February, March, and April, we are going to have more data that this continues to trend lower in the right direction. So let's take a look at where inflation is and isn't. I always love pulling up this chart after a CPI report. You can see that rent still sticky on a 12-month rolling basis, 6%. Here's your overall inflation sitting at 3.1. Still a few things above that, right? Rent, personal care, restaurant, meals, pets products, housing, and your earnings. You do want to see earnings above the rate of inflation, just shows that consumers and companies still have purchasing power in relation to inflation. But look at everything that's now significantly below, and even some deflationary items too. Rental cars, airfare, gasoline, toys, school books and supplies, appliances, used vehicles, furnitures, household energy, electronics. Now, these are important things. Now, they're not food and shelter, right? But they are important components of your CPI, all down. Then you have a mix of things that are lower than your 3.1. So as a whole, guys, a lot of things are trending back to what they used to be. Now, are a lot of those things going to benefit from price decreases, as you're seeing pretty much in these lower items? No, not every item needs to be in a deflationary cycle. We just need overall inflation to just continue trending towards target and maintaining a stable line of price increases. So just keep that in mind. That's the most important thing that I wanted to showcase from today's pretty much inflation report, is that it wasn't as bad as expected here, guys. And here's your services read. So you'll see services, if I can move my big head out of the way, services, less energy services was your major component here, January 2024. You can see that they represented a 0.7% month over month increase here for your services, and 0.6% of that came directly from your shelter costs. So that is a very bad read in itself, but a lot of other things are currently coming down or maintaining relatively flat. Now, in terms of shelter, guys, a little bit of a discrepancy here in terms of your shelter costs, right? Because if you take a look at Zillow has a very large amount of data on rental capacity and rental prices. And take a look at these rental market trends in most of your top rental markets in the United States, right? So these are 1 year charts pretty much on the day. So Phoenix, you can see down. Look at all these charts, guys, down from a year prior. So real estate and rental increases are obviously benefit from a lag effect. They're slower to react to the market than the rest of things. Obviously, because if you're a tenant, your landlord can only increase the price of your rent once per year. They can't do it every single month, such as you're seeing on a rolling basis with a lot of other items, let's say food or other items that can be adjusted fairly easily by other companies, right? Rental prices can't. So they've been lagging. So I do believe we're just experiencing currently a little bit of the lag, right? That has just been a case of landlords increasing the prices in early 2023 up until the midpoint of 2023. But after that, I do believe we should get some better comparative results as we move on lower and lower, further and further into the year, We should be getting some easier comparables in terms of doing some analysis on your rental prices. And I do think that rental prices as a whole have been coming down. It's just you don't see that yet in the CPI reports when we look at it comparing with an early 2023 basis with those increases as a whole. So all that being said, guys, hope that provided some light insight into CPI, and obviously was a big detriment to the market here today. So we'll get into some technical analysis of exactly how the market stands after this CPI report. Are the bulls in control? Are the bears in control? We're going to get into all of that juicy details here. Sorry, guys, just deleting all this stuff, right? Now we're going to do a couple earnings, and we're going to do them quickly because I want to focus a lot on the technicals today. Now, first company is going to be looking at is Coca Cola. Now, Coca Cola, I won't be doing an in-depth review of their balance sheet because I don't believe it's needed. Coca Cola didn't really change much in its balance sheet, even though I had a glance at it, right? No tremendous expenses increases, no tremendous miscellaneous item increases or shareholder compensation, right? Everything is fairly streamlined. Coca Cola has a very, very solid balance sheet. They reported earnings earlier on the morning, and I was curious to see if they were going to reiterate the same things that Pepsi said last week in terms of the company's kind of running out of pricing power, how most of their revenue increases has come from increase in prices, not necessarily increases in volume. And Coca-Cola literally said the exact same thing as Pepsi. So double beat on earnings, beat on EPS, beat on revenue. Is the company still moving in the right direction? You can see that right here, guys. Absolutely. Coca-Cola is moving in the right direction. Expanding EPS, relatively low rate though, however, about 4 or 5% per year are they expanding EPS. Coca-Cola, a very mature company, not a growth company anymore, so that's to be expected. And they are increasing revenue by about the same degree, about 5-6% per year. Coca-Cola, extremely healthy, pay a nice dividend, legacy brand, not going anywhere, fairly cheap off the all-time highs, right? Around 11-12% off your all-time highs. I really do like Coca-Cola, guys. Anything above 58 really down to 55 is a juicy opportunity to be picking up some Coca-Cola for the long term as they get through some of these temporary issues with their pricing power right now. But let's take a look at exactly what happened on their earnings. So Coca-Cola sales beat estimates helped by higher prices. Exactly what was said during Pepsi. Not necessarily that they're selling more stuff. It's just the stuff they're selling has higher prices. So that's why it's increasing their revenue, right? Not what you want to see. That is synonymous with the company losing pricing power. Consumers don't want to pay the extra prices, which is why you have less consumers, but the increase in prices makes up for that lack in volume. Coca-Cola on Tuesday reported quarterly earnings that met expectations and sales that topped estimates as higher prices helped the beverage maker overcome a volume decline in North America. Same thing as Pepsi. Coke reported fourth quarter net income of $2 billion. Very nice. 46 cents per share, down from 2.03 billion or 47 cents a share a year earlier. So same thing, Q4 over Q4 comps, Pepsi and Coca-Cola both down. Now, net sales rose 7%, which is similar to Pepsi. Coke's organic revenue, which strips out acquisitions and divestitures, climbed 12% in the quarter. Pepsi's organic revenue climb was a bit lower, if I do recall correctly here, about 10-11%. So, North American volume shrank 1% as demands for Coke water, sports drinks, coffee, and tea fell. For comparison, rival Pepsi saw its volume for its North American beverage unit fall 6% in the fourth quarter. So, falling less than Pepsi, but still falling. Pepsi executives said higher borrowing costs and lower personal savings squeezed consumers' budgets, leading shoppers to seek out private label options or smaller pack sizes. Coca-Cola saying mostly the same. Coke CEO James Quincey said some North American consumers with less disposable income have been squeezed more by inflation. Those shoppers have focused more on affordability and spent more time at home. For 2024, Coke is forecasting organic revenue growth of 6-7% and an increase in comparable earnings per share of 4-5%. So Coca-Cola and Pepsi going through a little bit of a lull period. Is it a troublesome indicator for the future of the company? I really don't think so here, guys. When interest rates start coming down and consumers start regaining their purchasing power, I do believe these stocks will just go back to business as usual. They won't have to do any more price increases, but the volume of consumers purchasing their products will come back. So their lack of purchasing power will eventually be compensated with a recapture of that volume that they've been losing here over the past couple of quarters. Not any red flags for the longevity of the business whatsoever. You guys know how well established Coca-Cola and Pepsi are as brands and how integral of a part of people's lives they are, just for their snacking habits, right? Snacking and drinking habits as a whole. Not really nervous for the company. That being said, it may take a little time to turn around. So don't expect tremendous earnings beats from Coca-Cola or Pepsi. It's just a time to be accumulating some shares at some lower levels. And I do believe towards the second part of the year, the outlook for Coca-Cola and Pepsi should be looking a lot better. Now, the second stock we're going to cover is going to be AirBNB. So AirBNB, we are going to be doing a little bit more of a deep dive because they're midway through their growth expansionary phase. So really need to pay attention to the fundamentals. So AirBNB, bit of a mixed reaction here in the after hours. You can see they really popped nicely after hours, about 10% sold off everything, and now we're actually down almost 5% in the after hours. So what exactly happened to AirBNB, guys? Well, they missed on EPS, but before you react negatively to this number, this is just due to a one-time tax expense for the company. So we've seen this a few times in this earnings quarter so far, guys, just because it's the Q4 2023 ending quarter. You have a lot of companies that will have one-time items that they're just expensing on their balance sheets. So this is what hurt their earnings per share. If it was not for this one-time line item, they actually would have came in line. So this EPS miss, little bit of a misleading factor here. Obviously, the tax expense is a real expense, so they have to pay it. So they did actually miss. But if you remove these one-time items, the company actually did a very good job. It's not because they overspent money on operating expenses that they necessarily came down on EPS. It's just that one-time tax burden. Now, revenue actually had a nice little beat, 2.44%. And when we get into their nights and experiences, guys, you'll see see that this company is growing at a very, very fast rate. I like Airbnb, but in terms of the valuation here, guys, we need to be a little bit careful for the valuation, okay? We're going to compare it to a few of their industry peers. Now, let's take a look here. So the EPS for 2023 was a little bit of an outlier. So when they returned to normal EPS, this is just because they had a few one-line items over the course of the year in terms of their balance sheet that they were able to pull forward, and then they expensed a couple at the end of the year. But all in all, it gave them tremendous EPS, but not really standard EPS. They're going back to standard EPS growth 2024 and onwards. So let's take their 2024 standardized EPS estimate for 2024, and the stock price is currently trading about $143 divided by your EPS of about 4.36, which is about a 32 price to earnings ratio, right? Just about a 32 price to earnings ratio. Little bit high for Airbnb. Let's take a look at some of their competitors in booking.com. So take a look at booking.com, right? We didn't go through their earnings. They didn't have earnings yet, but we went through Expedia. If you take a look at booking.com, a bit cheaper, and they are increasing EPS very, very aggressively in terms of booking.com here. So if we take their 2024, right, the price of this stock is currently trading $37.20 divided by your forward EPS, 176.14. That gives them a PE, forward PE of about 21. So significantly cheaper than Airbnb. And the company has obviously been more consistent than Airbnb, still growing revenue, still expanding very nicely. And if we take a look at the last one that we looked at last week for Expedia, you will see that them as well are a bit cheaper than Airbnb. So we're just doing a little bit of intra-sector analysis right now, right? So we take 134, let's say the price of Expedia divided by their 2024 expected earnings, it's going to be about 10, right? So their PE ratio is extremely low. Expedia actually representing some of the best value for one of these companies in relation to your travel segment, right? That's why I really liked Expedia so much after their dip. Very, very juicy opportunity indeed. But Airbnb, one of the more richly valued stocks, if I do say so myself. That being said, I do really like the company. If we come back down 131 all the way down to 126, I think it's a great area of previous resistance, should be acting as newfound support at this point as well. And the valuation comes down a little bit more than where it currently is, roughly about 10% more, which really helps us bring us down to a PE of under 30. But as of now, companies expanding nicely. So the fundamentals are there. They are generating nice free cash flow, and they are buying back shares. And the company is now profitable for pretty much the second year running in a row right now. Very, very nice as a whole. So let's take a look at some of the headlines. Airbnb reports better than expected revenue and beats on guidance. So the company also announced approval to buy back up to $6 billion of its Class A common stock, according to a release. $6 billion is a fair amount here, guys. The market cap is only about 97, let's call it 98 billion, right? So 6 divided by your 98, it's about 6% of outstanding float is the company going to buy back. So very, very aggressive buybacks as a whole. That's what you like to see. In a shareholder letter, Airbnb said the company is at an inflection point after spending the past 3 years upgrading and adding features to its main room sharing service. Airbnb said it's investing more in under-penetrated markets abroad in 2024, and that it will share plans to expand beyond its core business later this year. Very interesting. A lot of people think that they're going to do a somewhat of a rewards system. So you guys know that booking.com and a lot of other websites like Expedia, they have reward systems. They give you points and dollars every time you book. A lot of travel participants, wherever your travel, whatever travel website you're using, most of them do that, but Airbnb does not. So curious to see if they will be rewarding users for doing that. So Airbnb said revenue in the first quarter will be between 2.03 billion and 2.07 billion, while Wall Street was expecting 2.03 billion. So this is the beat up in guide. So they did have a nice little increase in their guidance for the first quarter. So that's always nice to see. And they do have nice plans for 2024 as well. Company will continue expanding. Airbnb said guest demand remains strong, particularly for first-time users. The company said that after the volatility affected the business in October, when the Israel-Hamas war broke out, its nights books growth accelerated through the rest of the period. So after this little bit of a mishap here in October, November, and December were very good months for the company, in other words. Average daily rates increased 3% from a year ago to $157 in the fourth quarter, and the company ended 2023 with 7.7 million active listings, up 18% from a year earlier. So more and more people hosting their property on Airbnb. That's exactly what you want to see. Airbnb, that just means that there's more availability for consumers and more of a possibility for Airbnb to generate some very beautiful net income on all of that extra revenue from those new participants. Now let's take a look at some of their financial metrics, and you'll see that they're fairly good, guys. Nothing bad really to say about the company. Shareholder compensation is a little bit high. We'll get into that lower, but in terms of the rest here, guys, fairly solid company nonetheless. If we take a look at just before we do that, just want to give you guys the financial snapshot here, if I can pull it up. So financial snapshot, you'll see that very, very healthy. The balance sheet is extremely healthy, guys. Take a look at these quarter endings, right? Cash and cash equivalents, we'll see that they ended the year in their statements here with about $10 billion in cash and cash equivalents. They posted free cash flow this past year of about $4 billion. So very, very, very good. But you can see here, this is a running total of their debt, obviously. Don't have a lot of debt. So the business is growing aggressively. They don't have a lot of debt. Tons of cash and cash equivalents, and are free cash flow positive. All things that we want to see in a company. So revenue, we're going to do the fiscal year because I think it's more important. So fiscal year, 18% year-over-year increase, revenue almost up to $10 billion. Very good. Net income, well, on the quarterly basis here, guys, this is when you see the one-time expense. So Q4 net loss of $349 million, including non-recurring tax withholding expenses and lodging tax reserves of approximately $1 billion. Excluding these, the net income would have actually been $489 million. Now, I agree with you guys. Taxes are a real expense, so you do have to encompass that into the calculations, but all in all, still making about $4.8 billion in terms of net income on all of that revenue. So very nice profit margins for the company as a whole. Take a look at their free cash flow generated over the course of the year. $3.8 billion added to free cash flow for the year, which is absolutely substantial, guys. If you could be making $10 billion of revenue and bringing almost 40% of your total revenue in terms of free cash flow, that's extremely good. Very nice metric to see that, by the company here. 39% free cash flow margin is exactly what I was talking about. Now, gross booking value, $73.3 billion in gross bookings, right? So 16% increase year over year. That's exactly what we want to see. Double-digit growth, revenue, and gross bookings. This is exactly what we're seeing with Uber as well. And nights and experiences booked, 14% increase year over year to 448.2 million nights and experiences booked. Very, very good. Quarter over quarter was 12%, but year over year, really like to see this double-digit increase to 14% as well. Now, let's get down to a few things in their balance sheet. And I promise I won't take too much of your guys' times on this. Let's just scroll down ever so slightly a little bit here until we get to their balance sheet. I apologize for this, guys. This is going to be the most important thing. So here we have a couple nice graphs as well. Quarterly revenue increase. You can see here, guys, very nice quarter over quarter expansion from 2019, 2022, 2023, expanding nicely. Right? Quarterly net income as well. This is your one-time tax event, so it's negative, but technically it is still respecting that growth curve as well. And that is pretty much it. Free cash flow too, quarterly free cash flow. Now the quarterly free cash flow is going to be low because of that tax expense I just showed to you guys. But if it wasn't for this, they would be steadily expanding their free cash flow. Year over year free cash flow, trailing 12 months was absolutely insane, right? Very beautiful increase here of about 39. They have 39% free cash flow margins, relatively in line with what they posted Q2, which was about 41% free cash flow margins. But free cash flow continuously just increasing year over year. Love to see it. And shares, decreasing shares as they continue repurchasing shares. They repurchased 2.25 billion of shares in 2023, and now an extra $6 billion outlaid for that coming in the next year too. So looking forward to seeing that on Airbnb. Now, let's get into a few of their items. So let's do a bit of math here together, guys, and that's pretty much all that we're going to do. A couple little items here. We're not going to go through a lot. So take a look at the revenue. Does the company have operating leverage? Now, the revenue increase, we saw it was about up 18% year over year. So if you just do that math, 9917, 8399, you can see that that's your 18% gain on your total revenue right here. Now, did the costs and expenses go up? Did the cost of that revenue go up more than 18%? No. So company still has operating leverage, 1703 divided by 1499. You can see that their cost of revenue only increased about 13.6%, where revenues increasing 18. So as long as your costs are increasing slower than your revenue, company still has positive operating leverage. And I do expect this to continue. So that is very, very good in itself. Now we're going to go down to the cash flow statement here and just take a little bit of a look on one thing that I wanted to show you guys, which I'll be bringing up more and more just to really drill it into everybody's head, how important this is, stock-based compensation expense. You remember we looked at S&P Global the other day, and they only had about 1 and 1.5% of stock-based compensation in relation to their total revenue. Take a look at the stock-based compensation expense for Airbnb. $1.1 billion. You guys remember how much revenue they made, right? On the year, 9.9, 1.1 divided by your 9.9, right? 11% shareholder compensation as a percentage of total revenue. A bit high in my liking. This is one thing that I don't like with this company. Yes, it is a growth company. It's new on the market, so we expect them to be paying out a lot in terms of stock-based compensation, but this eventually needs to come down as a percentage of total revenue. It cannot keep expanding here. It cannot be 11% of total revenue. Even though the company's profitable, even though they have very good margins, even though they're positive free cash flow, they could just be even more positive free cash flow, right? So if they bought back 2.5 billion of stock over the course of the year, but they paid out to management and executives 1.1 billion. So there's the dilution effect, right? So the net effect of their stock repurchases is 2.5 minus your 1.1 billion, only a net effect of stock repurchases of $1.4 billion. This is why this number is so very crucial to understand, right? Very, very, very crucial to understand. But in terms of the margins, guys, I mean, their margins are great. I mean, their net margins are really absolutely insane, right? Your net income here, take a look at your net income in terms of the company, right? So 4792 divided by 9917. So they have net profit margins of 48%. That's absolutely insane. It really is absolutely insane that they can be generating that amount of margins here over the course of the year. Yes, they had a few miscellaneous expenses that they're including in here, right? But very, very decent net margins. If you remove those miscellaneous expenses as a whole here, guys, we could do a little bit of quick math, but it was about 2100 divided by 9917. About 21% net margins when you remove these miscellaneous items. So very, very good. That's roughly in line with what the company has posted in the past, right? If I move myself over, you can see that a few quarters here, 26% here and there. Last year as a whole, 2022, 22% as a whole. And this year as well, about 22%, like we just did the math right there. So very decent net margins. I'm not complaining that they don't have money. It's just they pay out too much in stock compensation. If they didn't pay out that much, if they paid out half as much or a third as much, your bottom line would be even better, guys, and we could stretch this valuation a bit more. So stock compensation definitely matters. So that's pretty much everything for Airbnb. Just quick recap, guys. I love the company. I will be buying the company if it's down to 131, 127. Company's going in the right direction. They're obviously a product that everybody loves to use, and I do expect them to do great things in the future, expanding EPS, expanding revenue for the next couple of years in terms of the forecast. So I would have no problem here buying this company going into the next couple of years as the travel boom just simply continues and will get even more intense when interest rates come down and people regain that purchasing power. Now, let's get into the nitty-gritty of the markets, guys. Are they going up? Are they going down? Let's take a look. Now, we were looking at yesterday, loss of the hourly trend. So I was focusing on the fact that this was very important leading into the rest of the trading week, right? This loss of your hourly trend right here, loss of the higher low. Then we were looking, can they set the lower high into lower low? Well, they never bothered. Look, this is overnight trading session, right? 4, 5, 6 in the morning before your CPI. So even before that, they just continued the hourly flush. No real chance to set an hourly lower high into a lower low flush. They just continued, and then the flush really accelerated on the morning. Now, bulls, after that, they are having a chance to reset the hourly trend change. So it's going to be very, very important for us, guys, to watch tomorrow's trading. Tomorrow's trading could be the sign that we're in for a few weeks of consolidation or new all-time highs, and I'll explain. It's all reliant on the size of the bull's bounce. So you can see second leg down here, nice bounce. How much of the bounce did the bulls get? Well, enough of a bounce, 80%, that they have the chance of reverting the hourly trend to the bulls. If they revert the hourly trend to the bulls here, guys, we were always looking for a daily higher low. Anything above 483 was just for a daily higher low for further trend continuation. So let's not forget the bulls never lost the trend. This has happened a few times in the past where the bears have had a one-time single day event that has really surprised the markets. It happened last time when Federal Chair Jerome Powell was speaking 31st of January. You see this right here, big flush. We were just looking for a higher low, anything above 470, higher low, and the bulls were able to recapture. It happened here as well, where we're in a beautiful daily uptrend. The bears flushed the lows, but could they convert this into a daily downtrend? No, the bulls just recaptured it. We have not had a daily downtrend since pretty much the month of October. All of these one-time little fearful events or whatnot have all eventually been able to be recaptured by the bulls. So it's going to be very important to see if we can convert this hourly move into an hourly trend change tomorrow. We'll be looking, can the bulls just resume course as if nothing happened and discount this CPI report, just as the Federal Reserve interest rate watch tool here has been forecasting that rates, the probabilities for rate decreases are now even higher in May and June because of this report. Can the markets just turn around and discount this after today's red? Remains to be seen. However, if once we set this hourly trend change, we then roll over, what are we looking for, guys? The 4-hour will be crucial. You guys remember me talking about this 12 EMA on the 4-hour, how if we lose it in a significant fashion, could set up for a potential 4-hour downtrend into a little bit of daily consolidation move. Well, that is what we're going to be looking at, guys. Tomorrow is extremely important. If they set the hourly trend change, we're looking, because of the size of this move down, most likely scenario, 4-hour lower high, into a potential 4-hour lower low. The size of this bounce on the 4-hour will be crucial in telling us whether or not we're heading for further daily consolidation or whether or not the bulls are going to be able to just V-shape this. You can see the daily bulls reacting nicely midday and closing above your 12 EMA. So 12 EMA on the daily, still acting as beautiful defense, but keep your eye on this hourly trend change. It is absolutely crucial. The bulls still have a lot of space, anything above 43, right? Daily higher low for further trend continuation. Keep an eye on this hourly. If the hourly just rolls over into tomorrow, then the bulls will take back too much of this move. We could be looking for daily lower high after that and lower low conversion, similar to exactly what we got over here. If we lose this and set up a lower high into daily downtrend continuation, look, when you get the engulfing move, it gives the bears a chance to set the lower high and lower low. But whether or not the bears take that chance, right? Here they didn't take it. Here will be once again an opportunity. If we roll over tomorrow to get into these lows, and the closer you get, the probability increases that you set the lower high into lower low. That would be weekly consolidation. If we're talking about weekly consolidation here, guys, 480 down to about 470 is going to be the key level. Anything pretty much above 466, just looking for a weekly higher low for further trend continuation. Now, the reason I think that we might just lead in to a daily downtrend and weekly consolidation. Few reasons, guys. We're almost through earnings season. There's no more big tech earnings except for NVIDIA next week, pretty much to save the day for us. So most of big tech earnings are out of the way, and a lot of your major tech companies are in overbought conditions. Secondly, the markets as a whole are in overbought conditions on the weekly, across the board, across all of your major indexes pretty much. Number 3, we do have very greedy market conditions right now. So it used to be extreme greed the other day, right? Previous close yesterday was 77 greed. We're now back to greed. We're still greedy. Number 4, seasonality. Notice we're at the midpoint of February before we usually drop off, have a sketchy start to the month of March, and then March and early April are usually good. So February seasonality as a whole comes through the midpoint. 10th and 11th trading day, guys, is Wednesday and Thursday, tomorrow and Thursday of this same week. So for those 4 reasons alone, I do believe that it is highly likely that we get some extended daily consolidation into weekly consolidation, which would just offer the chance for the monthly bulls as well to potentially set a monthly higher low into the month of March and then rally for April and May, going into that May Federal Reserve meeting. Once we have more data, the next CPI reports, guys, if they keep coming in hotter than expected, but keep coming down, meaning like, let's say next month, the expectation is for 2.7% year over year, but we get 2.9, that's fine. That's still lower than 3.1. Will markets not be happy because it's over expectations? Yes, but it's still lower. All we want is lower numbers, guys. So I wouldn't be surprised if we do roll over. However, I also wouldn't be surprised if we simply continue on our march past these all-time highs right here and recover this and continue overbought conditions until we have another negative catalyst, until we just get so overbought, guys, the market can't turn the other way. I wouldn't be surprised, but in my mind, it's not the likely scenario. The likely scenario at this point, guys, will be for a little bit of a rollover, even if we just go sideways for a few weeks, guys. I'm not calling for an immense drop, right? Even if we just trickle down sideways, beautiful weekly consolidation, cool off these weekly time frames. So that's why I've been trying to warn everybody for the past week and a half that a sell-off like this could be potentially occurring. It's just natural market movement in overbought conditions. When a lot of your big tech is overbought, a lot of your indexes are overbought as well. So tomorrow, absolutely crucial day. Tomorrow's trading will set the trend, in my opinion, for the next 2 to 3 weeks. Now, moving on to QQQ, same principle. Daily uptrend, just looking for a daily higher low, anything above 416.73. Daily higher low, looking for further trend continuation. However, the size of the move on the hourly is considerable on QQQ. No chance at a lower high, lower low short position snipe, so I was not able to enter my NASDAQ short. I usually wait for the confirmation of that. Never got it, and we just really got blown out here. By the time I woke up to watch CPI, we were already down from yesterday's high, pretty much, 1.5%, right? So I just wasn't going to do it. I was waiting for maybe a pop on CPI to potentially roll over into a short to just further consolidate the markets, but never got the opportunity to do it. But QQQ, same rules pretty much, right? So hourly oversold conditions may be leading us in to an hourly bounce. If we get the hourly trend change, then we're looking for a 4-hour lower high, potentially 433, and I will maybe making a play on the short here for potential lower low conversion, which will just send us up here into potentially further daily consolidation. But that is just speculation. As of now, the bulls remain in full control. But tomorrow is key. If we roll over this hourly, they'll take back too much of this move and they open the door for something like this, where they take back too much of the move, right? And then the likely scenario becomes for lower high and lower low. But will the bears be able to convert? So far, they haven't been able to convert. Haven't been able to convert here, haven't been able to convert there, couldn't even convert back here when it was really easy for them to just take this and set the daily downtrend, could not even convert into December period either. So let's just see, will they be able to convert this to the downside? If they do, weekly consolidation, then we're still looking out 405 down to about $400 is our first target, all the way down to 386 at the really brutal end to it, guys. But I wouldn't be opposed to just coming back down to this 12 EMA. From the top to this 12 EMA, it will be about 5-6%. That's a decent little sell-off from your tops here. So it remains to be seen if QQQ can do that. Just a reminder, bulls, full control, monthly control. Even if we pull back late February, early March, monthly higher lows, guys, for further trend continuation. Weekly bulls are in full control. Anything above 395, just a weekly higher low. And daily bulls, until proven otherwise, still in control. So the short trade opportunity is still on the table. If we bounce up here, I will be taking a short right here. Stops come above here, and then we're targeting pretty much the lower levels here on the daily. We'll be targeting this low right here, 417, and then for potential further continuation through all the way to about 412. So the trade still is on the table for the short. The bears have put in the room to open up that trade for us. Will the bulls roll over this time, or will it be another case where we just engulf the move and continue as if nothing happened? As I said, guys, the report wasn't bad. It was just hotter than expected, but it's lower than previous readings. Now, moving on to healthcare, financials. Financials really didn't like that report, but recovered nicely intraday. Beautiful little bounce intraday, like pretty much the rest of the market, right? So financials still kind of trapped, never cut these previous lows. So financials still in daily consolidation at this point. What you don't want to see is a break of 38.25. If you break 38.25 to the downside, could be setting up here for the loss of the daily uptrend into potentially daily downtrend reversal. 38 down to 37.50 is going to be your big area of support. Daily bulls look very healthy here, guys, until we lose 38.25. They are still in control. On the weekly, however, we have just been consolidating sideways now for a better part of the last 2 weeks. So if ever we do get a little bit of a rollover, I wouldn't be too nervous, guys. Why? Because we have so much juicy support down here. 38 down to that 37.50 level is going to be juicy area of support. 12 EMA is down there as well. Your higher low is right down here at 37. And if we do get down there, guys, from top to bottom, that would represent about a 4-5% sell-off on financials, which we really haven't had since the beginning of this rally here in pretty much early November, right? So could be warranted for a little bit of a sell-off if we continue increasing here on the speculation of yields. Then take a look at yields. Let's do that right away. So yields, you can see here, setting the daily uptrend, and now also setting back in motion the the weekly uptrend here, guys. Same thing on the 10-year, right? Weekly uptrend has been reset. Weekly MACD crossing the upside. Weekly MACD potentially crossing the upside as well. First time since we really had this come down in the end of the month of October. But in my opinion, guys, this is literally just speculation. On the longer term time frames, just looking for a monthly lower high, lower low continuation to the downside. Monthly as well, monthly lower high and lower low continuation to the downside. Rates won't be going up. So there's no reason, guys, for these things to be close to 5% in any case, in any event, right? So we're just going to be eventually looking for these bond traders to end their speculative bets into the end of the year. As we get closer and closer to that first rate cut, guys, it's going to be really tough for these yields to sustain these higher levels, because when we start that rate decrease cycle, it will be a fairly aggressive cut cycle, right? So these will be able to drop considerably. But now, since we're now in an uptrend, right, the bulls control the short-term timeframes on this, little bit of speculation on yields, which is not good for financials. So the whole time that we may be getting a little bit of uptick in speculation on your yields here, financials and growth stocks may be taking most of the blow. Now moving on to healthcare. Healthcare, you know, relative to what else happened today, performing fairly decently. So healthcare has a ton of space in relation to other indexes, right? So anything above 137.25, just looking for a daily higher low. We do have a nice area of confluence right here. This is your previous resistance, right? Which is about 141.60, and just above that, around the 142, is your area of all-time high. So we really have a juicy area here of support to be basing into. That being said, healthcare nonetheless dropped today, 1% to the downside, still protecting your 12 EMA. The key here will be watching how much of this move do the bears take back. You don't want to see them take back too much, because then it opens the door for daily downtrend. If that eventually does happen, just get ready, because we'll just be looking for a weekly consolidation, anything above 137.24, just a healthy weekly higher low. And as a first stop, guys, we need to get back under these all-time highs. We put in a nice little move above them. Remains to be seen if they can be used as support. If whichever reason they can't, well, down here, you obviously have much wider support, 137.36, your weekly higher low. So bulls with a lot of space to work with here, guys. Not really worried about healthcare as a whole. Now, the Russell. So the Russell is exactly what we were saying yesterday here, guys, right? If CPI were to be bad and yields were to increase, well, the Russell would pretty much be the unfortunate bearer of the bad news, right? So that's exactly what happened today. Top to bottom, from yesterday all the way to the bottom of today, guys, almost 5% on the Russell, but really doesn't show, does it? Because we've really been trapped within this range of price action for a better part of the last month and a quarter at this point. So on the Russell, we were looking, the bulls had the daily uptrend back in their control, but now in jeopardy of losing it again. The size of this pullback in one day is fairly nasty. So now we're back below our area of resistance. This area of resistance, guys, in my opinion, is going to be tough for the Russell bulls to really crack this until we get some confirmation of rate decreases either in May or June. And that's only going to come, guys, with further and further amounts of data. So jobs reports and CPI need to be pointing in the right direction for those rate cuts. Now, on the Russell, right, not above our area of resistance, going to be challenging for the bulls to get above this pretty much. So going to be looking, can the bears set a 4-hour downtrend in motion? If they do that, guys, well, watch out, your daily higher low, 190.28. Lose this, you lose the daily uptrend. You set up the possibility for a retest of this resistance zone and then potentially lower lows. If that happens, guys, we absolutely need to protect this low right here, 187.73. If you lose 187.73, you set up for the weekly downtrend. Weekly downtrend would just be monthly consolidation, but still really take some of the wind out of the bulls. And at that point, we'd be looking, guys, still my area. If we come down 187 down to about 181, I will be looking to buy the Russell. I've been patient so far, so let's just see if that trade indeed comes to me. But as of now, guys, very, very nasty reset. The one good thing that they have for the bulls is this is a very juicy area of support that we're trying to get through right now. But if yields keep going up and the rest of the market keeps consolidating, guys, I don't believe the Russell will be spared. We most likely will get that daily downtrend in motion, and then we will be targeting this midpoint of this whole nasty range that we've been stuck in for the longest time at this point. Now moving on to the Dow Jones. Dow Jones also having one of its worst days in recent memory here, but Dow Jones, contrary to the rest of things, had a very steady line that we could base our support off of. It was the 12 EMA, and now you can see it lost on a consistent basis. It only This only happened, guys, back here in mid-January, and they were able to recapture this fairly aggressively thereafter. But as of now, still has to be notable to us, have lost the daily uptrend at this point. We were looking to preserve these lows right here, 38,136. We flushed it, and then we recovered, yes, but we still flushed it. So what we're going to be looking out for, key thing for tomorrow, if the Dow Jones can manage to set a bounce, set the hourly uptrend back in motion, and really kill this daily move to the downside, or if we roll over on the hourly, set the hourly downtrend, guys, it will be a loss of the daily uptrend confirmed at that point. Then the bears will have created a lot of space to set up for a daily higher, lower high, and then lower low conversion. At that point, we'd just be looking for healthy weekly consolidation, anything above 37,134. Healthy weekly consolidation, decent resistance, which is now going to be support 37,800-ish. Then we have our 12 EMA. So I do believe the Dow Jones will be able to put a stop to things down in this lower portion of the chart right here. And we are significantly off the all-time highs as well. So even if we lose this area right here and challenge lower, we could just be heading in for monthly consolidation towards our previous all-time highs. That's about 36,600. Still a decent away from the price right now, but those are just the levels to watch out for. Crucial for the Dow Jones. For the bulls, if they want to play defense, they're going to have to show up here for the rest of the week of trading. If not, the bears will create too much space, guys, and the Dow Jones isn't as volatile as your QQQ is, let's say. So if they really bring down this a lot, your probabilities can really expect a downtrend continuation by the bears. Now, let's get into our big tech names, shall we? So Apple still consolidating sideways, right? So range bound, we were looking the size of this bounce here, looking for the bulls to set up for the daily trend change. Now, the size of this bounce, the daily bounce, was nice, over 618%, which gave the bulls a good opportunity of creating enough space to set the daily higher low for further trend continuation. But with the markets falling apart right now, we are targeting potentially the retest of this zone right here on Apple right now. I don't really like it at this point, right? Hourly downtrend is recaptured by the bulls. We'll see if they can get it back. By the bears. We'll see if we can get it back tomorrow. If we can get it back tomorrow, we're going to be looking, can they convert this to the daily uptrend over the next couple of days? If they fail it and start retesting here, guys, well, the daily downtrend will potentially be likely at that point. We will just be looking for further weekly consolidation, but be careful, break 180, and you're in a weekly downtrend on Apple. That would just mean further monthly consolidation. At that point, guys, we are still targeting the lower end of this range right here. If I can get Apple towards the 175 level, I will be very happy. So Apple really in a little bit of a chop zone here. Crucial area right now. The bulls can still save the daily uptrend if they get their butts in gear over the next couple of days of trading. Still need to mount above this previous support, which is now resistance area 190 down to about 187. If they can't do that and use this as resistance and roll over, daily downtrend confirmed, we're going to be looking out for the weekly downtrend flush of 179. And at that point, guys, 175 is going to be a crucial area of support by the bulls, but still looking fairly good for monthly consolidation in terms of Apple. So no red flags just yet. The red flags come on a break of these lower areas of support. Now, AMD holding up better than most here, guys, today. AMD was down a ton on the morning. Take a look at this morning open. Pretty much from yesterday's close, right? They were down almost 4.5% at one point over the course of the day today. So very aggressive sell-off from AMD pretty much, right? About 4.5% to the downside, but ending only 0.22% to the downside. Very good. AMD is maintaining this tightening range. This is what we were looking out for, guys, but keep an eye on the flush, 162.60. If the market continues red into the next few days and weeks, if we get this flush of pretty much 162.60, we have lost the tightening range pattern. It would be daily downtrend confirmed. And if we break through this area 164 to 158, which is your previous all-time high area of support, at that point, weekly consolidation will be heavily underway. Going to be targeting this 12 EMA. 155 is your next area. Anything above 133, just looking for a weekly higher low for potential further continuation once we're out of this February and March seasonality. But AMD has now been consolidating sideways for a better part of the past 3 weeks, cooling down the daily time frame in the process, slightly cooling down the weekly time frame, but still overbought, guys. AMD can still pull back a significant amount before not being overbought anymore. So just keep that in mind. Bulls still looking good. And obviously, if we break to the upside, 180 break to the upside would just be recapture of the daily uptrend to the bulls. And then we will be looking for weekly continuation, your weekly lows having been set. So fully relies on this. I don't think AMD is going to do anything on their own at this point. They will just be beholden to the rest of the moves in the market. That being said, I'm not buying AMD personally until we maybe dip down into a 150, 140 handle. Now moving on to Amazon. So Amazon, 2.15% to the downside today, but it could have been worse, right? So Amazon, unfortunately, losing the daily uptrend. That's a loss of the lows right here, 168, right? They had the higher low, higher high in motion. So daily uptrend after earnings was in motion. Now they have lost it. So we will see, can the bears convert on this and set up a daily downtrend? If they do, just going to be looking for the gap fill, guys. 159.53 from after earnings. So much space on the weekly, right? Weekly uptrend on Amazon. Looking for a weekly higher low, anything above 145, just looking for that weekly higher low. And I will heavily be looking for Amazon, guys. If we dip back into the lower 160 area, I will heavily be looking to make some plays on this, right? So that after their highest point on their earnings would be a discount of about 10, about 10%. So I will be looking for that discount. In my opinion, if SPY and QQQ consolidate 5, 6, 7%, some of big tech will go at a discount of about 10, 11, 12% at the most. And that's probably all we're going to get, guys, and then is going to be back to the races for the rest of 2024. So let's make the most of these dip opportunities if they do come. Amazon not looking so good. Not looking so bad right now, just in typical weekly consolidation now that your daily trend has been lost. But playing some good defense. Remains to be seen. Can the bears convert this into daily downtrend for further weekly consolidation for a couple weeks? Or will the bulls just chill out right here for a little bit before putting in more gains right now and just setting that weekly higher low and going for higher? Either which scenario, guys, 161, 160, I'm going shopping for some short put options. Now, moving on to Google. Google as well, dropping about 2%. So the crucial area of Google is coming up here soon. So we were looking, after having lost the daily uptrend right here, we were looking for the size of this bounce in relation to the move down. Now, I was always saying that Google put in a fair bit of a bounce, right? Above our 618, almost up at 70%. So it gives them some good probabilities of being able to set the daily higher low for further trend continuation, for further trend change to the bulls. But if the rest of the market continues consolidating here, guys, need to watch out for these lower levels right here. They're going to be key. 141 down to 138. Cannot lose this low. If you lose this low, it's a daily downtrend and also would be a weekly potential downtrend as well at that point, and then would be heavy monthly consolidation for Google. I would really appreciate that if we revisit the 131 areas, but I don't think at this point that it's likely for Google. I think that the 141 to 138 is heavy support for the stock currently. So I am a fan of buying Google stock. If we get back down to 141, 138, if we go further than that, down to the mid 130s, I'll be buying some more of that too, because Google's valuation right now for what it is extremely cheap. It's actually the cheapest big tech stock in terms of fundamental valuation. So I will be looking for any discount that I can get on Google. But as of now, bulls still just looking to set the daily higher low for further trend continuation. How do you know that's being set? Need to see a reversal on the hourly time frame. So it remains to be seen, will we be able to get that? Look at this beautiful recovery after your pre-market CPI dump and double bottom at the low of the day. So we're going to be seeing, can they change this to an hourly uptrend? If they change that to an hourly uptrend, guys, daily higher low is set. Then we'll be looking, can they crack the 150, 179? So Google currently in between situations right now. So we need to focus on the buy zones. If Google comes down here, right, tough to predict which way the rest of the market will follow into tomorrow. One thing's for sure, if we come down here, I'm buying down here. Moving on to Meta. Meta as well, 1.87% to the downside, right? Almost in jeopardy of losing your lows. This would kind of look like Amazon, right? If we lose these, you would just be losing the pattern formation of after earnings. So we're looking on Amazon, on Meta. Can we set the daily downtrend? If we break these lows right here, 455, let's call it, that will be daily downtrend confirmed. At that point, you're just looking for further weekly consolidation. Meta has been consolidating a little bit now for ever since their earnings, right? Tons of space on Meta, anything above 341. Just going to be looking for a weekly higher low, still overbought on the weekly. And that's the problem with a lot of these stocks here, guys. On the weekly, Amazon still a little bit overbought. Google and AMD, no. AMD, yes. Apple, no. Amazon, right, overbought. Google, not overbought because they didn't perform that well after their earnings. But Meta, and we'll go through the list, guys, a lot of still overbought conditions on the weekly, which is why if we do continue consolidation, it's just going to be healthy. Allow all these things to get back down to normal levels through our February and March seasonality, and then we're back to the races for the rest of the year. So I would not be opposed. This could be the last buying opportunity for a lot of big tech before continuation into 2024. So that's what I'm looking at on Meta. Keep an eye, 455, lose that, continuous weekly consolidation. And at that point, guys, we'll just be looking, when can the bulls recapture the daily uptrend? That's when you know your weekly higher low is set. Now moving on to Microsoft. So Microsoft, 2.15% down on the day here today, right? In jeopardy of losing your daily uptrend. So this is pretty much your low right here, 402.82. If we lose this, daily uptrend is lost. The bears create enough space to potentially set up for a daily lower high for lower low conversion, and then we head into weekly consolidation. Microsoft heavily still overbought on the weekly, but this one day of price action, guys, has resulted in a lot of weekly timeframes coming down ever so slightly. Would only need a couple more weeks like this, even sideways consolidation action, right? Even maybe below 400, that wouldn't be so much of a discount from the all-time highs. All-time highs all the way down to about 390. 380, let's say, only about 7 to 9% worth of drop for Microsoft. Not that much, but it will allow for some very nice cool down of the higher time frames. So, gonna look, can the daily bulls maintain this control, or will we roll over? If we do roll over, just looking for a weekly higher low, anything above 365, just looking for a weekly higher low, guys, for further trend continuation into 2024. Could line up with our seasonality, right? All of this is so far lining up with our seasonality. So far, bulls not yet losing control, but when you see an engulfing move like this, just sets up the probabilities for continuation, then lower high, lower low into weekly consolidation. And on the monthly, guys, Microsoft's looking super healthy, right? Even if February and March, early March, take a little bit of a dip, we'll just be looking like this, and then into April and May. Now moving on to Netflix. Netflix setting the daily downtrend continuously in motion. So, right, so this is pretty much the extended version of what Meta is trying to do right now. You can see Netflix has been doing it for a while now, not dropping that much, but still daily downtrend is started, which means that we're still just in weekly consolidation, third week of weekly consolidation. And look, in only 3 weeks and a terrible CPI report, apparently, Netflix from the earnings high is only really down about 4 or 5%. That's really not that much in the grand scheme of how much they moved after earnings, right? So doing a great job of maintaining the top end of this range here. 575 is the area of resistance they've been struggling with, the top end of this 2020, 2021 range. I do believe they'll be able to maintain within this range. So the whole time that we maintain daily downtrend by the bears right here, I will be looking to snipe this weekly lower high. My sweet spot for Netflix, if we can get down to 520, close as possible to 520, 510, that's where I'll be looking to write potentially some options on Netflix. Really like the company for the long term. It's just that now we're in a bit of daily downtrend consolidation, and just some weekly consolidation. Anything, guys, above 461, just looking for a weekly higher low for further trend continuation, right? So looking good, but just cooling down that weekly time frame. Daily is now cooled down, but just cooling off the higher time frame, so may just be due for 1 or 2 more weeks of consolidation here, sideways action at best before potentially making another stab here at that level. Now moving on to NVIDIA. NVIDIA, I mean, if you look at NVIDIA today, right, if you only looked at NVIDIA, you wouldn't be able to tell that the entire market fell off a cliff pretty much, right? And that's kind of normal. NVIDIA just holding up the gains very, very nicely into the end of the day. So NVIDIA, unlike other ones, not losing the daily series of higher highs and higher lows, right? Very clear on the chart right here. Anything above 606, just gonna be looking for a daily higher low for further trend continuation at this point. Not pulling back a lot in relation to the size of the move just yet. I would start getting a little bit more worried if we started coming back all the way to 635. We pull back all the way to 635, the bulls would have lost a lot of ground and may lead in to a lower high, lower low situation after earnings. If earnings aren't to expectations, the stock could take a severe little tumble. Earnings coming up on NVIDIA here next Wednesday. So in my opinion, price action at this point, since we only have about a week to go, will be fairly muted for NVIDIA in that respect. But nonetheless, very, very good performance on the day and on the weekly, guys. So much space. So even if we do pull back with the rest of the market, even if earnings is a disappointment as well, I don't expect it to be a disappointment in terms of they're going to miss their numbers. It's just maybe the growth expectations may be tapered back a little bit, right? So we'll see what happens. But on the weekly, guys, anything above 477, just looking for a weekly higher low for further trend continuation. So tons of space for NVIDIA, daily and weekly charts. No red flags whatsoever. Now, our three last ones. Tesla. So Tesla coming undone here today. Interest rate sensitive play, obviously. 2.18% to the downside. So Tesla in jeopardy once again of continuing this daily downtrend. So we're looking at the size of this bounce. It was a considerable bounce. I'll give that to the bulls right off the lows. Bounced about 80% of your most recent leg down, which gave the bulls a good probability of setting a daily higher low for potential daily trend change. But now with interest rate sensitivity up, very hard for Tesla to kind of move against the grain in that respect. Even if the technicals showed that the bounce was nice, guys, this stock is just too beholden to interest rates at this point, and that's why the momentum is really plaguing them against that. That being said, even if we start retesting these lows here, guys, we are at a very big area of support. And you can see now, guys, since earnings for the past 3 weeks, really haven't been able to really close below and under this whole area right here, 180 down to about 173. Same problem that they were having back in March and May of 2023, right? They can pull down into this zone, but very hard for them to crush the levels beyond that. Tesla's car business fundamentally is valued at about $140, $150 per share. So over and above that, any advancements that they make in AI, robotics, subscription fees in terms of FSD or insurance and stuff like that, it's not even priced in to that $140, $150 share price for their autos alone. So really coming down to fair value on Tesla. I'm really not opposed to making some plays here on Tesla. 170, 160 levels, fairly juicy as of now. The bulls desperately trying to defend these lows right here, 175.54. Lose that. Unfortunately, daily downtrend just continues. Weekly down move just continues as well at that point. Going to be eyeing the bottom end of the trend line and the lower end of this support area. So we'll see if Tesla can get it done. All relies, just like the rest of the market, can they change the hourly trend into tomorrow? Now moving on to Palantir. Palantir consolidating considerably, 4.15% to the downside. So red day, but a green candle, bit of a counterintuitive thing on Palantir, but looking fairly good, guys. We were always looking for this pullback after such a significant rise after earnings, right? We're talking pretty much after the day of earnings, right? 45% to the upside. So consolidation was inevitable. You had a severe overbought conditions here on your daily RSI. Weekly RSI is not so bad, however, but we have been pulling into this area where a lot of trapped equity could be since the post IPO and a lot of profit taking. So you have trapped equity from everybody who's break even here. And you have a lot of people who are currently up, anywhere between 2, 3, 4x from buying all in this period right here. So really a good area of supply for Palantir shares. Could be a lot of selling, and now it does appear that the selling is coming in as the rest of the market pulls back. People might just be taking profit on Palantir. We will be targeting a daily higher low, anything above 16, just looking for a daily higher low. And the target for me, guys, 12 EMA, and this line right here, $21.36. It's your previous 52-week highs, and it's also a relative bottom of this previous range right here. So 21.50 down to about 21. This whole little pocket right here is the area that I'm targeting. Daily bulls still looking extremely healthy, and even on the weekly, guys, I mean, there's so much space. Even if Palantir consolidates for the next 2-3 weeks, you really won't be able to tell something exactly kind of like Netflix, right? So that's it for Palantir. And now lastly, PayPal. PayPal still just consolidating in our cannot lose zone. So pretty much $60 down to 57 is going to be the cannot lose zone for PayPal. It's been previous support a bunch of times in the past, this whole area right here, and support here previously. The reason it's so crucial, guys, is once again, I'll remind you, it is your areas of weekly higher lows. So we've been in a nice weekly uptrend ever since the month of October at this point. Nice weekly uptrend. And now if we close below here, we're going to lose that. So bulls cannot lose this $57 range. It's extremely important to your long-term structure if you want to have a potential stab at breaking counter trend on the monthly chart as well, and really breaking above this downtrending channel that I keep reiterating that we've been in since August of 2022. Right, so about a year and a half at this point for PayPal. Bulls struggling, right? We had a nice little bounce undergoing right here. PayPal interest rate sensitive, down 3% on the day with that increase in yield. So remains to be seen if we get that daily downtrend conversion by the bears, losing 55.81, then unfortunately, guys, daily downtrend is set, your weekly uptrend is lost, and then we will be targeting downside targets at that point, guys. At that point, $54. First stop, and then all the way as low as $50. Unfortunately, I don't believe PayPal will get down there on its own. If it does get down there, it's going to be a byproduct of the market, not because something is necessarily wrong with PayPal as a whole. And if it gets down there, guys, I will be averaging down on some PayPal shares for sure, as I do believe this is going to be a nice transition year for them. And when rates start coming down, should be very beneficial for this company as well. PayPal and Tesla should be benefactors to the upside of any rate decreases whatsoever. So we're currently in limbo right now. You really want to see the bulls mount this $60 level at that point and use it as support. So we'll see what happens tomorrow. Can we regain the hourly trend in our favor and start mounting the levels again, potentially using them as support and retrying this downtrending weekly trend line right here. So that's pretty much everything I had for you guys today. Apologies for the longer video, but really wanted to set the expectations leading into the next couple of weeks. So all that being said, guys, I hope that I didn't come off as too bearish. Just a little recap here. The CPI report, although it came in hotter than expected, it still shows the inflation trend is down, right? It's been down on a consistent basis, and that's what we want to see. Spot number 2 is the bulls are still in control of these indexes. Remains to be seen, will the bears finally capitalize? They've had a lack of ability to capitalize in the past few months since November, pretty much, right? So still, the bulls are in full control. It's up to the bears to prove to us that they can roll these over. And if they do roll these over, guys, on the dailies, just always remember who's in control of the markets on a long-term basis, right? It is your weekly bulls. Your monthly bulls are in full control as well. Rate decreases are coming in 2024. Inflation is still trending lower. The jobs market's healthy and the economy is healthy. So nothing has changed with today's price action, just cooling down the markets after very overbought conditions. And this is just traders benefiting from a negative news event to really start that consolidation to be underway, right? Everything was overbought, few signals there. So just some decent consolidation underway. And you can see in 1 day of trading, dailies on a lot of these indexes here are now no longer in overbought conditions. Now we just need to eliminate some of the weekly overbought conditions, and that could take a bit of time, which is why I say may just be in for some daily downtrends, but some shallow little weekly consolidation moves may be just ahead of us here for your February seasonality leading into early March. But after, I do think April, May, as we start getting into that hype of potential rate cuts in May and June, I do think that we're going to be much better. So as usual, guys, if you learned anything or found this video helpful, consider liking the video. Would really appreciate it. Consider subscribing to the channel if you're new. And as always, if you have any questions, leave them down below. I'll get back to you in 24 hours. See you tomorrow after the close. Peace.